Peter Lynch says, buy a business that's so good that an idiot can run it because sooner or later one will. One of the most important things to remember in stocks, very hard to do, but people have all these feelings about it.
People don't understand their natural advantages. That's bad, number one. But worse, number two, if you don't think you're a good ice skater, or if you're convinced you're not a good cellist, you're not going to go out and try it. But people are buying stocks anyway.
Yeah.
They're not discouraged, they just think it's a gamble.
Yeah.
That's a mistake.
So your advice is what?
If you don't understand a company, if you can't explain it to a 10-year-old in 2 minutes or less,
yes,
don't own it.
Picking the right business is just like flipping a coin. It's really just a 50-50 chance if you even make money on it, right? Then why do 89% of all fund managers, aka the smartest investors in the world with extraordinary intellect, when it comes to financial markets, actually fail to even beat it? You see, the market goes up on average 10.49% annually, yet why do only just a select few even beat it? Okay, how about this? In 1973, a Princeton University professor by the name Berta Malkiel claimed that a blindfolded monkey throwing darts at a newspaper's financial pages could select a portfolio that would do just as well as one carefully selected by experts. Now that sounds completely ridiculous, but it was in fact right. And not just right, but exceptionally correct. This study created 100 portfolios every year containing 30 stocks in each one. And they tested this theory every year between 1964 and 2010, selecting 100 portfolios. Now on average, out of 100 portfolios, how many do you think outperformed the market? You'd assume it was 50, of course, because I said it was better. And it probably wouldn't be much more than 70 or capped out at 70 because that's just absurd, right? Funnily enough, 98 out of those 100 portfolios beat the market. So essentially you have a 98% chance of beating the market, just getting no emotions attached. Just for a year you hold 30 stocks and you repeat each year for however many years you want to do it. Instead of the clearly worse option, which is putting your money in a hedge fund and they manage it day to day, which only has 11% chance of beating the market. Even crazier still, Warren Buffett, acknowledged as the greatest investor of all time, in 2008 placed a $1 million bet that an S&P 500 index fund would outperform 5 of a man named Ted Seed's hedge funds. And over a 10-year period, Warren Buffett's index fund returned an annualized 7.1%, whilst all 5 of Seed's funds returned a cumulative 2.2%. Now what does this all mean? Does picking a stock require emotional durability, a bit of luck, or a complete understanding of the business? To be truthful, it's all of the above. Hey, my name's Hank Campbell and I'm on a journey to educate millions of people just like you in personal finance. In this video, we're going to cover some of the basic quantitative and qualitative analysis to help any beginner investing. And as always, my videos are not financial advice at all, but stick to the end of the video because there's some really cool insight you have to see. We'll start with qualitative analysis, which is where we throw out the financials and focus on all the company's advantages. This includes brand recognition, whether it's in a growing industry, its current financial climate, the management team, and whether it has a moat. We'll start with brand recognition, and when I say the word Apple, what's the first thing that comes to your mind? This is a finance channel, so obviously you'd think the company instead of the fruit, and this is because Apple's product is so deeply embedded in our current day society. Now, I could even say the phrase electric car and you'd instantly think of Tesla instead of other competitors like Neo or Rivian. A brand name instantly brings trust for the consumer as they always think of it as being good quality or a good service that has been offered to them instead of some off-putting brand that no one knows of. Here's a really cool graphic of some of the biggest brand names in the world along with some of the largest growing ones. And personally, I invest individually in some of these larger brands including Amazon, Tencent, Facebook and Alibaba because I know they'll continue to be reputable worldwide. Next is understanding the current financial climate. And right now, since the market downs across the board, exploring investments into any company at a discounted price is a viable option. Some companies like Alibaba have been absolutely slaughtered in the markets recently, however can provide some great buying opportunity if there are strong fundamentals. And on the flip side, 2001 saw the dot-com bubble where prices were soaring everywhere and there was no clear fundamentals, so yeah, that's a signal to sell. A great management team that's experienced in its company's field is another great thing to look out for. Characters like Elon Musk bring a positive image to the company's brand. Now you see how you know instantly that Elon is the CEO of Tesla. That in fact means that he's a positive role model for the company. Now everyone knows Mark Zuckerberg owns Meta. However, the wider public sees him as more of a negative role model. So examples like this are another key factor on why I pick my stocks. Representing a growing industry or sector can be an enormous opportunity to get high returns, although difficult to select the correct investment. The dot-com bubble saw many promising businesses fall under. Nonetheless, if you found the gems at this time, you'd be extremely rich by now. Prospects such as the metaverse, electric vehicles, artificial intelligence, cloud computing, blockchain, machine learning, and many more may provide explosive returns as they can be adopted heavily into the future. Finally, one of Warren Buffett's essential steps to find a great company is identifying its moat or competitive advantage. If you haven't seen the movie The Founder, it's about a businessman named Ray Kroc who noticed the opportunity in fast food and then applied his fierce business and sales mind into creating this little fast food chain called McDonald's. Now at the time during the 50s and 60s, fast food wasn't a thing, but he perceived an opportunity in the market or a competitive advantage in fast food, which is the norm everywhere now. Now that you've understood the 5 steps of qualitative analysis, it is now time to grasp some simple financial concepts that every beginner must know. When you're investing into a singular company, it is always important to look at its financials. I can't believe I'm saying this, but stocks are like first dates. Qualitative analysis, like we saw earlier, can identify the outside things such as nice hair or lovely eyes. But quantitative analysis can dig a little bit deeper and find the flaws in someone, or in this case, a company. And these problems can be little small ones that we don't have to worry about too much, or some rather large ones that we need to stay clear of. I personally use the website Yahoo Finance to look at financials, and in today's video, we're going to use Meta as an example. After searching for the company, you have to press onto the company's financials tab, and then it will display the 3 key reports to choose from, including the income statement, balance sheet, and cash flow statement. First, we want to look at the income statement, and at the top of the page under total revenue, we can look how much money the company generated for the quarter. And if we scroll further down, we can see the net income, which is the total amount made after expenses have been deducted from the total revenue. The expenses we tend to look out for are the operating expenses and the cost of revenue. Cost of revenue for Meta would be their research and development costs, such as in the AR and VR space, their servers, machine learning, and so on. The little breakdown is the total revenue minus the cost of revenue equals gross profit. And gross profit minus operating expenses equals the final operating income for the company. Now, a way to pick if the company you chose is a healthy business, we get the operating income and divide it by the total revenue. Then multiply that just by 100, and hopefully the number you get is above 0.15. For Meta, we can give this a test. As you can see, this is an extremely healthy company. Next, we look at the balance sheet, which obviously said in the name, balances assets and liabilities. And this is a similar concept to how we calculate someone's net worth, which they may have a $5,000 car and $3,000 worth of cash, so $8,000 total in assets. But if we have $6,000 in student loan debts, we take that away from the original assets, so $8,000 minus $6,000 equals a $2,000 net worth. And this is essentially what a balance sheet does, just weighs up assets and liabilities. First, we have to break down the assets, and as you can see, we have both the current assets and non-current assets. Current assets are assets, I'm saying assets so much, but are assets that can be turned into cash within the next 12 months. Whilst non-current assets are assets, oh my god, I'm sick of saying assets. There's no better way of saying it, but they're assets that can't be turned into cash, that have to take at least 12 months, and this is property or headquarters that are illiquid. Now, an intangible asset is the value of the brand of the company. So one that's been trusted for many years, and they just put a number on how much it's worth. Now we move on to current liabilities, which is debt that has to be paid off within the next 12 months. And non-current debt obviously is like the same thing as earlier, can be paid longer than 12 months. But a simple calculation you must take note of is total current assets divided by total current liabilities. And if this number you calculate is greater than 1, then this company can pay off all its debt within the next year, and hopefully there's some spare cash for the likes of dividends and reinvestment. So if we try Facebook or Meta, we're going to get a result of 3.15, which is an extremely healthy company that hopefully can continue to grow. The last one of the 3 reports is a cash flow statement. Now this part isn't really too deep and is normally focused on dividend companies, unlike Meta. But if you see their free cash flow consistently going up, then you can trust the company will continue to pay dividends. At the end of the day, I preach the same, not financial advice in dollar cost averaging consistently and always diversifying your portfolio. I also believe in balancing between both ETFs and individual stocks, as well as any other investments such as housing or crypto. Anyway guys, thanks for tuning in to how I pick my stocks, and click the last video over here, which is the 10 steps to reach financial abundance. Don't forget to like the video and subscribe down below, because I'm trying to get my message out to as many people as possible, and you contributing to support the channel contribute to do so. I don't know. I forget it every time. Don't forget to use the link down below to sign up for CoinSpot. Don't forget to follow my socials down below. But anyway, guys, hang out. Yeah. Where's a coin? If this lands on heads, I have to invest all my money in Luna.